Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and the Challenger go head-to-head on buying a home in 2026 is still the best financial decision most Britons will ever make. Let's get into it.
Let me put it simply, £1,100 a month in rent buys you nothing. The same £1,100 on a mortgage at 4.15% buys you roughly £210,000 of property, and after 25 years you own a house worth hundreds of thousands of pounds.
But you're cherry-picking the monthly payment and ignoring everything else. A £285,000 house at 4.15% over 25 years costs £452,000 in total repayments, add stamp duty, solicitor fees, surveys, maintenance, and insurance, and the real cost starts looking a lot less like a masterstroke.
Of course there are costs, nobody's pretending otherwise. But at the end of those 25 years you have an asset. What does the renter have? A filing cabinet of tenancy agreements.
The renter could have a stocks and shares ISA that's been compounding for 25 years. If you take that £28,500 deposit and the difference in monthly costs and invest it, historical returns suggest you'd build serious wealth without chaining yourself to one postcode.
Historical returns, that's doing a lot of heavy lifting. The average UK house has delivered around 6 to 7% annual returns over the long term, and that's on leveraged capital. You put down 10% and get growth on 100% of the asset. No ISA gives you that kind of leverage.
Sure, but leverage cuts both ways. If prices drop 10%, your £28,500 deposit is wiped out entirely. We saw that during 2008, negative equity trapped hundreds of thousands of people.
And every single one of those people who held on through 2008 saw their property recover and then some. Property rewards patience. The stock market crashed too, remember.
But a diversified portfolio recovers without costing you £3,000 a year in maintenance, ground rent, and insurance. Your house demands cash just to stand still.
And your landlord is charging you for all of that plus a profit margin. Where do you think your rent goes? You're paying someone else's maintenance, mortgage, and retirement fund.
Not necessarily. In many parts of the UK right now, renting is genuinely cheaper month to month than buying the equivalent property. That gap is real money you could be investing.
In some areas, yes. But mortgage rates have come down, we're at 4.15% on a typical 2-year fix. That's a huge improvement from the 6% plus we saw in 2023. The window is opening for buyers.
A window that could slam shut at your next remortgage. You're locked in for 2 years. Then you're at the mercy of whatever the Bank of England decides. Renters can adapt, move somewhere cheaper, downsize overnight.
You call that freedom? I call it insecurity. A Section 21 notice gives you 2 months to uproot your family. Homeowners don't lie awake wondering if their landlord is about to sell up.
That's a fair emotional point, but we're supposed to be talking about finances. And financially, mobility is an asset. If a better job appears 200 miles away, a renter can take it. A homeowner has to sell, which takes months and costs thousands.
Most people don't relocate every few years. For the majority of Britons who settle in one place, buying is overwhelmingly the better deal. And let's talk about the deposit. Lifetime ISAs give you a 25% government bonus, shared ownership schemes exist, and some lenders now offer 5% deposit mortgages.
A 5% deposit mortgage on a £285,000 house means you're borrowing £270,750. The interest payments on that are enormous, and you're underwater the moment prices dip even slightly.
Prices have dipped slightly precisely once in the last 30 years and recovered within 3 years. The long-term trajectory of UK housing is up, supply is structurally constrained and demand keeps growing.
Past performance and all that. You're making the same argument people made about house prices in Dublin in 2006. Structural scarcity doesn't make assets immune to correction.
The UK isn't Ireland. We've been underbuilding for decades, We need 300,000 homes a year and we consistently deliver half that. That's not a bubble, it's a genuine shortage.
I'll give you that supply is tight. But that actually strengthens the rent and invest case if you can't afford to buy in the area where you work and live. Forcing yourself into a worse location or a tiny flat just to own something isn't rational.
Nobody's saying buy a bad property in a bad area. But people also underestimate the forced savings effect of a mortgage. Every payment builds equity. Most renters don't actually invest the difference, they spend it.
That's a behavioral argument, not a financial one. You're essentially saying people need to be tricked into saving by taking on hundreds of thousands in debt. Direct debits into an index fund achieve the same discipline.
In theory. In practice, the average British household has £11,000 in savings. Homeowners have average net wealth of over £300,000. That's not a coincidence.
It's also not purely causal. Homeowners tend to be older, higher earning, and more likely to have inherited wealth. Correlation isn't causation. Buying a house didn't make them rich. Being richer let them buy a house.
There's some truth in that, but it doesn't change the fundamental mechanics. Leveraged exposure to a scarce, appreciating asset with tax-free gains, no capital gains tax on your primary residence, is an extraordinary deal. The government is literally subsidizing home ownership.
And ISA gains are also tax-free, up to £20,000 a year in contributions. You don't need property to access tax-efficient growth.
£20,000 a year. A modest house appreciates by more than that in many parts of the country. Look, I'll concede that for some people, those who move frequently, those in wildly expensive areas, those early in unstable careers, renting can make sense.
And I'll concede that for someone settling long-term in an affordable area with a stable income, buying probably edges ahead, especially with rates coming down. But the blanket advice that everyone must buy as soon as possible, that's what I'm pushing back on.
For most Britons who plan to stay put, owning property remains the single most reliable route to building long-term wealth, and no spreadsheet fully captures the value of knowing your home is yours.
And for a growing number of young Britons priced out of sensible purchases, renting well and investing the difference isn't settling for less, it might genuinely be the smarter financial path.
The Guardian, The Challenger, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.